Hey, thanks for stopping by the channel. I know everybody is usually busy, and sometimes this financial stuff can be boring. So let's just jump into it without introduction. Mortgage debt consolidation is the process of using either a first mortgage or a second mortgage, like a home equity line of credit, to pay off one or more liabilities for the purpose of either lowering your monthly payment, saving interest, improving your credit, satisfying a creditor, or all of the above. Now, I'm going to show you like a real live example from a real loan that I did a couple years ago. But before I do that, really quick, number one, it's really important that you have a plan. Uh, I I don't want anybody to ever use their home to consolidate debt and then get back into this situation with debt 2 or 3 or 4 years later. That's just awful, god awful. So, you don't want to get into this without a plan and just throw a bunch of debts, pay them off with your house, and not address the real problem in the first place. Like, was it overspending? Or was it just something that caught you off guard? Next thing you know, you're up to your ears in debt. So just keep that in mind. I don't want to beat a dead horse, but make sure that you have a plan. Get with somebody that can help you. Obviously, we can help you. Mortgage loan originators, licensed loan originators, or registered loan originators can help you. But we're not financial planners. So talk to a professional financial planner if you have one. If not, maybe you have a family member that's really good with their personal finances that you can run this by, or maybe a really good friend that you can trust, and this good friend is really good with their personal finances. They've done good for themselves. Something so you don't end up back in that situation again. All right. Next, maybe explore some other avenues before tapping into your house. Maybe you've got some kind of old investment that's doing nothing. And it's just sitting there, 27,000, $30,000 or so that's accumulated. Maybe you can apply that. Maybe you can get the money from a family member. And I know I'm talking about some obvious stuff here, but all I'm trying to do is just get across, explore some other options before you tap into your home, uh, for the money. Okay, so next, selecting a loan product. Now, this is a really short amount of time to go into this. So just really quickly, number one, are you going to use that first mortgage or home equity line of credit? A quick example of using the first mortgage would be, let's say you have one of those 30-year fixed loans, 2.75%, 2.875, 3 something percent in the low threes, like a lot of people got during, when COVID, what that was at its height and the mortgage rate pricing was so low. So let's say you have whatever, a $400,000, $350,000, $500,000 loan at 2.75%, and you need maybe $27,000, $35,000 to consolidate the debt. Well, certainly you don't want to mess up that $400,000 sitting at a 2.75% cushy fixed rate that you got with no cost, a few years ago. So you want to use a home equity line of credit in that situation. Now, let's say you're you have like a 6.875 or a 7% rate, like a lot of people have that did some financing within the past year and a half or so. Well, consolidating that that debt now, it wouldn't be so bad. You can wrap that $30,000 into that first mortgage and get a rate lower than your 6.5 or 6.875% or 7% that you got a year to a year and a half ago, and do so with like no cost. So, that's just a couple quick examples. So interest rate is going to be the big determining factor. Now, if you've ever seen any videos that use home equity lines of credit out the get-go to consolidate debt because they think there's something special about a home equity line of credit, the interest on it, there is not. Absolutely, positively not. So don't believe that hype. I addressed that in a few other videos that I made about the subject of using a home equity line of credit to pay your first mortgage off faster. And I proved mathematically with calculators, amortization schedules, mortgage calculators, dictionaries. I provided tons of references to show that no, that actually is not a real thing. There's no type of interest advantage to using a home equity line of credit unless the home equity line of credit has a lower rate. All right, so let me jump to the next thing I want to talk about. There's going to be a short-term and a long-term strategy. So the example I'm about to show you is a long-term strategy. A short-term strategy would be like, say you're going to consolidate this debt and you're going to be moving out of the house in, say, 2 to 4 years. Well, you don't care about paying the house off. You're going to be selling it. But in the interim, you've got a debt situation that you want to take care of. And you can like actually combine that with a few other things. Like, say, for example, you're going to be moving in 3.5 years. You consolidate $30,000 in debt now to lower down your monthly payments. Now, on top of that, a lot of your debt was attributed to credit cards. And, having high credit card balances, over 30% of the limit can really start to hammer your score down. So you're going to put yourself in a position to buy your new home better. So you consolidate that debt. So you free up that cash flow for the next 2.5, 3 years until you buy that new home. Also, you've done something that's going to improve your credit. And maybe you also got a little extra money to fix up the house to get it ready for sale. And that would be an example of a short-term one where you're not so much interested with paying the house off because you're going to be getting out of there, but you use the house temporarily to put you in a better financial position. All right, so now we are going to get into the portion where I show you a real live example of some debt consolidation that I did using a first mortgage. So let's go ahead and jump right into it. Right, so these are real numbers that you're looking at here. Of course, I anonymized everything, but these are actual numbers that we did during our debt consolidation. So you can see here in this column, these are all of the approximate balances here from this 56,000 on down here. And then in this column, these are the minimum monthly payments associated with these balances. Over here, was the current principal and interest payment, about almost $1,650 here per month. And then that was at a 2.375%. And then these bills, all these bills added up right here in this column, those bills came to $2,975 a month. So these $2,975 a month in bills plus the $1,649 came to $4,624 per month. All right, folks, and so here is what we did. Now, choosing the right debts is important. That's part of that plan that we talked about at the beginning. You don't just roll everything in there. You got to make a strategic move with this. So like this one, they decided to keep because this was a student loan, and they were anticipating that this would get forgiven, which actually some years later, couple years later, it was forgiven. So that was a good move there. That wasn't included, but obviously you can see here, we decided to pay, and when I mean me, sitting down with the homeowners for a long time, and finally decided to pay this one, pay this one, this one, this one, and this one. So those debts added up to about $89,000 or so if you add all these balances together. Quite a big chunk of money that was added into the mortgage. So after adding that into the mortgage, you can see that took the payment from the $1,649 principal and interest to $2,104 principal and interest. So it increased the principal and interest, right? And then a 2.375 rate, we ended up going with 2.5 because 2.375 had some costs associated with it, and because of the debt we were consolidating, the homeowners decided, you know what, we already added enough in the mortgage, let's go at 2.5 because 2.5 was no cost. So we went with the 2.5, and so now the bills went down from $2,975 to $1,605 after we consolidated these bills. It went down to $1,605 for the remaining bills that were not paid. So $2,104 plus the $1,605 in bills made now the payments $3,709. So that's the new mortgage payment, principal and interest, plus the bills that are left over, $3,709. So we freed up we got some cash flow now. So what do we do with that cash flow? Well, we've got $915 cash flow now after paying these $85,000 approximately in bills. And then these are the remaining bills right here that we see here. So let's take this $915 and put it to work. All right, it's time for the snowball effect here. So we took that $915 and we put it towards one of the debts. This debt right here that you see shaded out now, this $45,000 debt with a 440 payment. One of the reasons we attacked this one first because it was small, so it'd be quick to pay off, and it had one of the larger payments. That's a good strategy to use. Attack the small ones with the largest payments first. So that's what we did here. So we killed this $4,500 debt, and that freed up an additional $440 cash flow. We were able to pay that off in 5 months. And so that increased the monthly cash flow $1,350 to $1,355. So it was $915 plus the $440. Now we've got cash flow of $1,355. So let's put that $1,355 to work now. All right, so we took that $1,355, as you can see here, and that went towards the $8,000 debt. It had the $500 payment, as you can see right here. Now I have it shaded out. So that went towards that one. So that debt paid off in 6 months. And that increased the cash flow to $1,855. So killed one more debt. Took only 6 months to kill this $8,000 debt. Now we've got an additional $1,855 cash flow. So do we stop there? No. Remember, we sat down for several hours and we created a plan, several hours over a few days, and we had a plan. And so now we're executing this plan. They were staying in touch with me. Boom. So we they killed another debt here, and now $1,855. So do we stop there? No. Let's put this $1,855 to work. So we took that $1,855 and applied it toward, as you can see here, the $7,500 debt with the $225 payment. We killed that bad boy. That took only 4 months because now we're working with the $855 cash flow. So it made quick work of that $7,500. So that took care of it in 4 months, increased our monthly cash flow, $2,080. Ba-boom. All right, so now we go have a party, right? We take that $2,080 and we go to Vegas, right? Of course not. We put it to work. All right, so here's what we did with the $2,080. And this is in progress right now. This is happening right now. So that you can read along here that the $2,080 cash flow, that went towards the mortgage. And the funniest thing, people like outside of the industry that really don't know what we do, they think we just put people in 30-year mortgages and leave them in there. No, we do what's going to be best for each individual homeowner. That's what the whole interview process is about. That's why we take so long when we're interviewing people, and then we adjust the plan as we go along, as things change. So all because you do a 30-year loan, you certainly do not have to keep it for 30 years. It's going to put a gun to your head and say, keep the 30-year loan. So in this situation, the homeowner wants to pay this off before they both retire. Now they're not going to actually hit that, but they're going to come pretty close to it. So in the retirement, they're going to have a few more years left, but they have it was part of the plan. They have a great retirement. So they're going to be able to handle it no problem, because remember, they're going to have no other debts. They're just going to have the mortgage and there won't be much time left on it. So in this situation here, we took the $2,080, applied it towards the mortgage, and then we did a $532,500 30-year fixed mortgage. That included the $85,200 that we consolidated in bills. So you would think, oh my God, that's horrible, but no. The power of extra payments on a mortgage comes into play here. It kills me why so many people don't know about how powerful extra payments are. You don't even have to make large extra payments. Even small $150 extra payments will make a huge difference on how many years you shave off your mortgage and how much interest you save. But in this case, applying the entire $2,080 towards the mortgage took this, what would have been a 30-year mortgage with a tremendous amount of interest over 30 years, now down to 12 years and 2 months. Boom, just like that. $530-something thousand mortgage, which included, the previous mortgage, and $85,000 in crushing consumer high interest, compound interest debt, because that included the credit cards that are compound interest, gone. The mortgage and everything in 12 years. That is how you do debt consolidation on the mortgage side. And this debt consolidation is nothing special I did. a bank, a mortgage loan originator at a bank, a mortgage loan originator at a credit union, a mortgage loan originator at a brokerage, a mortgage loan originator at a lender can help you do this. This is nothing fantastic that some other people thought of. The mortgage industry has been doing debt consolidation long before I got into it, and I got into the mortgage industry 25 years ago. And of course, I'm still in it to this day. And so talk to a professional, talk to a licensed or registered mortgage loan originator, and it would help if I could say this, if they had some experience. And my apologies to the new originators if you happen to run across this. I'm not saying you're not good to go with, but I'd rather work with the me of today than the me of 25 years ago. Even though, I thought I was Mr. Hotshot back then, there's my opinion, there's no replacement for experience. So if you can connect with an experienced mortgage loan originator, wherever you go, your bank, your credit union, your brokerage, lender, and to assist you with the debt consolidation, get you on the right path, get you out of the debt, keep you out of the debt, and set you up for success in the future, you'll be doing good. So drop any questions, ideas in the comments section. I get to those comments pretty doggone quickly. Thanks for watching this video, and I'll see you on the next one.